Silver has carried a reputation for false starts and unfinished breakouts, and that history is exactly why the move through $94 matters more than it appears, because the market isn't reacting to the number itself, but to what it quietly exposes beneath the surface, and that exposure is only beginning to register. At first glance, the break looks mechanical, almost routine, driven by momentum traders and headline psychology, yet price behavior around 94 didn't behave like a clean technical event. It behaved like a pressure release that had been delayed too long, hinting that something structural was being tested rather than confirmed. Underneath that price print sits a deeper tension between paper positioning and physical signaling, where available data suggests futures markets were prepared for volatility, but not for persistence. A mismatch that doesn't resolve cleanly and instead leaves participants recalibrating in real time, which is rarely a stable process. What's unsettling for institutional desks is that 94 wasn't supposed to attract long-term capital, it was expected to repel it, and when resistance fails to do its job, it raises questions about who was leaning against it and why their weight suddenly mattered less. The discussion quickly drifts toward 100, but that round number isn't a destination, it's a compression point where liquidity thins and narratives collide, and the closer price drifts toward it without consolidation, the more fragile the path forward becomes. Historically, silver doesn't glide through psychological thresholds. It hesitates, overshoots, or snaps back. And when that pattern breaks, it forces risk managers to revisit assumptions they thought were settled, opening internal debates that rarely stay contained. Behind closed doors, the focus isn't on whether silver can print 3 digits, it's on what happens to positioning if it approaches that level without flushing excess leverage first, because crowded trades don't unwind politely. What makes this phase different is the absence of a single dominant driver, with macro signals, currency behavior, and industrial demand, all contributing just enough to keep price elevated without offering clarity, a combination that breeds unease rather than confidence. Even the language around the move has shifted, away from excitement and toward caution, as if participants sense that the easy explanations have already been used up, leaving only harder questions about sustainability and timing. And as silver holds above 94, without the expected recoil, the market is left staring at a number it talks about constantly but understands poorly, setting the stage for decisions that won't wait for consensus. Historically, when silver clears a level everyone is watching, the real stress doesn't show up in price charts first, it shows up in behavior, and the behavior following 94 has been unusually restrained, suggesting hesitation rather than conviction, which is rarely a neutral signal. In prior cycles, breakouts were accompanied by aggressive volume expansion and fast narrative alignment, yet this time participation looks fragmented, with some capital leaning in cautiously while other pools step back, creating a market that advances without consensus and therefore without protection. What's quietly shifting is how risk is being distributed, because available data suggests the largest exposures aren't coming from speculative newcomers, but from entities already embedded in the system, adjusting rather than initiating, which changes how exits eventually form. This matters because silver's path toward 100 isn't just about buyers overpowering sellers. It's about whether existing holders feel comfortable staying exposed as volatility compresses, a condition that tends to break suddenly rather than gradually. From a structural standpoint, 94 removed a ceiling that had anchored short-term expectations, and without that anchor, models that rely on mean reversion begin to lose authority, forcing discretionary judgment back into the process, where mistakes compound quickly. There's also an asymmetry forming between downside fear and upside belief, with pullbacks being bought defensively rather than enthusiastically, a pattern that keeps price supported while draining momentum, and that imbalance can persist longer than expected before resolving sharply. Inside institutional risk meetings, the conversation isn't bullish or bearish, it's conditional, focused on scenarios where price approaches 100 without a reset, because those scenarios expose fragilities that don't appear on standard dashboards. Silver's history reinforces this discomfort, since major levels have a habit of acting as mirrors rather than gateways, reflecting unresolved positioning back onto the market instead of allowing clean passage. As price remains elevated without acceleration, the silence itself becomes information, hinting that the market may be waiting for an external justification it hasn't yet received. And the longer that justification fails to arrive, the more pressure builds around a number that looks simple on the screen but behaves anything but when approached too directly. At the institutional level, the difficulty with silver near 94 isn't valuation, it's visibility, because the signals that normally guide positioning have stopped aligning in a reliable way, leaving participants exposed to outcomes they can't easily hedge. Currency movements offer partial explanations, but none that feel complete, as dollar behavior has been supportive without being decisive, creating a backdrop that sustains higher prices while refusing to validate them, an uncomfortable place for capital that prefers confirmation. Industrial demand narratives have resurfaced, Yet market behavior implies they're being treated as reinforcement rather than drivers, suggesting that real consumption alone isn't carrying this move, even as it prevents a clean breakdown. What complicates the path toward 100 is that silver's identity is being stretched, pulled between its role as a monetary hedge and an industrial input, and when those roles compete, rather than complement, price tends to oscillate instead of trend. Positioning data, where available, hints at a market that has reduced outright shorts without replacing them with confident longs, creating a vacuum where price floats higher but lacks structural commitment, a setup that often ends abruptly. This vacuum also affects liquidity as market makers widen tolerance bands when directional clarity fades, subtly increasing the cost of participation and discouraging the kind of flow that carries markets smoothly through psychological levels. Historically, $100 has functioned less as resistance and more as a stress test, exposing whether demand is durable or simply opportunistic, and approaching it without a clear catalyst risks turning anticipation into anxiety. What's different now is the absence of panic on either side, a calm that feels deliberate, as if participants are conserving optionality rather than expressing belief, which can sustain price but rarely resolves uncertainty. The longer silver hovers in this range, the more the market internalizes 94 as normal rather than exceptional, a quiet recalibration that shifts future reactions in unpredictable ways. And as normalization sets in without resolution, the question isn't whether silver can reach 100, but what condition it arrives in if it does. For decades, silver's most consequential moves have occurred not during acceleration, but during pauses, and the current stretch above 94 carries that same uneasy stillness, where time becomes a pressure variable rather than a neutral backdrop. As days pass without a decisive push or pullback, shorter-term participants begin to lose relevance, replaced by slower capital assessing exposure through stress scenarios instead of charts, a shift that changes how price responds to even minor signals. This environment tends to magnify small catalysts, because when positioning is light and conviction thin, marginal news can have outsized effects, not because it's important, but because it offers an excuse to act. The problem for silver near 100 is that excuses work both ways, and without a dominant narrative, the market becomes reactive rather than directional, oscillating around expectations that no longer anchor behavior. Liquidity conditions reflect this uncertainty, with spreads subtly adjusting and depth thinning at key levels, indicating that participants are less willing to commit size until clarity improves, which in turn makes the path forward more fragile. From a historical perspective, when silver approaches landmark levels under these conditions, it often experiences exaggerated probes, brief moves that test tolerance before reversing, leaving behind distorted signals that confuse late entrants. Risk managers are acutely aware of this pattern, which is why hedging activity appears to be increasing quietly rather than aggressively, a sign that protection is being layered without conviction about direction. The psychological weight of $100 compounds this fragility because it attracts attention without providing information, drawing in observers who amplify noise rather than liquidity. As attention grows without alignment, price becomes more sensitive to internal imbalances, reacting to shifts in positioning that would otherwise go unnoticed. And in that sensitivity lies the risk, because markets that move on imbalance rather than belief rarely stop where participants expect them to. Behind closed doors, discussions about silver at these levels are less about upside targets and more about sequencing, because the order in which pressure resolves often matters more than the direction it eventually takes. One concern surfacing is that the market hasn't meaningfully tested downside acceptance since clearing 94, leaving uncertainty about where genuine support begins if sentiment shifts, an absence that complicates any approach toward 100. Historically, when silver advances without revalidating prior resistance as support, the eventual test tends to be sharper and less forgiving, catching participants who assumed time alone would do the work. This creates a paradox where stability becomes destabilizing, as prolonged calm encourages complacency while quietly increasing the distance price could travel once balance breaks. Another layer involves derivatives behavior, where implied volatility remains controlled even as spot price holds elevated, a combination that suggests confidence in range, but vulnerability to surprise, an asymmetry that has consequences. When volatility is priced cheaply near major psychological thresholds, it often signals not foresight, but exhaustion, as participants grow tired of preparing for events that haven't yet arrived. Approaching 100 under these conditions risks forcing volatility to reprice suddenly, turning a symbolic level into a mechanical trigger rather than a milestone. Market history suggests that when silver's volatility resets, it doesn't do so gently, and the direction of that reset often has less to do with fundamentals than with who is forced to act first. As optionality narrows, patience becomes expensive, and participants who delayed decisions may find themselves reacting instead of choosing. And it's in that reactive phase, just below or just beyond 100, that silver has historically revealed whether a move was earned or merely tolerated. At this stage, silver's advance is being judged less by where it trades and more by how it behaves under scrutiny, and the behavior near 94 continues to send mixed signals that resist easy interpretation. Some flows imply strategic accumulation, yet they lack the urgency that typically precedes sustained extensions, suggesting that confidence is conditional rather than embedded. What complicates the outlook is the absence of a clearing event. No sharp liquidation, no forced reset, no decisive catalyst, leaving the market suspended between narratives without resolving any of them. In previous episodes, silver's path toward major levels was cleared by stress, either through rapid pullbacks or explosive advances, but the current environment favors neither, increasing the risk of a disorderly adjustment later. The closer price drifts toward 100 under these conditions, the more that level functions as a referendum on market structure rather than a price target, exposing weaknesses that accumulation alone can't conceal. Institutional behavior reinforces this view, with positioning adjustments appearing incremental and reversible, a sign that participants want exposure without commitment, a stance that can reverse quickly. This reversibility matters because it shortens reaction time, meaning that when consensus shifts, it does so abruptly, compressing volatility into narrow windows. Silver's historical tendency to overshoot during these windows adds another layer of risk, as moves become exaggerated not by conviction but by urgency. As the market edges closer to a number everyone knows and few trust, the distance between intention and outcome narrows. And in that narrowing gap lies the potential for a move that feels sudden, even though the groundwork has been visible for weeks. At the institutional level, the quiet question isn't whether silver deserves to be near 100, but whether the market has earned the right to approach it without consequence. And so far, the answer remains unresolved. What's striking is how little narrative reinforcement has followed the price move, as if participants are reluctant to articulate reasons that could later be challenged, a restraint that speaks to uncertainty rather than discipline. This reluctance shows up in allocation behavior, where exposure appears diversified across strategies instead of concentrated, reducing individual risk, while increasing systemic sensitivity to correlation shifts. As silver hovers closer to 100, correlations become more dangerous because assets that previously moved independently begin to respond to the same signals, tightening the web of reactions. Historically, this is where silver becomes unpredictable, not because fundamentals change, but because relationships do, and those shifts tend to surface suddenly rather than gradually. Another pressure point lies in expectations management, as analysts and desks prepare clients for scenarios rather than outcomes, a subtle acknowledgement that precision has given way to probability. When markets operate in probability mode near symbolic levels, behavior becomes defensive, and defensive behavior often amplifies rather than dampens volatility. The irony is that the closer silver gets to 100 without incident, the more dramatic the eventual incident tends to be, as pent-up adjustments find release. This doesn't imply collapse or continuation, only that resolution rarely matches anticipation, a lesson silver has enforced repeatedly across cycles. And as attention intensifies around a number that feels inevitable but remains untested, the market edges toward a moment where restraint may no longer be an option. Historically, the final stretch toward a level like 100 is where silver stops behaving like a trade and starts behaving like a system, reacting less to inputs and more to internal strain. By this point, expectations are embedded, not just in positions, but in risk models, mandates, and performance benchmarks, meaning even small deviations can force actions that feel disproportionate to the trigger. What makes 94 significant in hindsight is that it removed the last widely trusted reference point, leaving 100 as the next anchor by default rather than by design. Approaching a default anchor is dangerous because markets treat it as stable until it suddenly isn't, and when it fails, there's nothing immediately behind it to absorb reaction. Institutional memory of past silver cycles adds to this tension, as prior encounters with major thresholds rarely resolved cleanly, creating a bias toward caution even as price advances. This caution manifests as staggered exposure, layered hedges, and shortened time horizons, all of which increase sensitivity to momentum shifts instead of reducing it. As a result, the move toward 100 becomes less about conviction and more about tolerance, testing how much imbalance the system can carry before something gives. The paradox is that nothing needs to happen for pressure to build, because in markets like this, inaction itself becomes a form of positioning. And as silver stands closer to a number that feels both symbolic and unresolved, the market approaches a point where delay is no longer neutral. For decades, silver has punished certainty more than skepticism, and the move beyond 94 reinforces that lesson, because it exposes how fragile confidence becomes when a market advances without resolving its internal contradictions. The idea of $100 carries weight precisely because it promises clarity. Yet silver's history suggests that clarity rarely arrives on schedule, often emerging only after expectations have been disrupted. What matters now isn't whether the number is reached, but whether the structure supporting the approach can survive contact with it, a distinction that's easy to ignore until it's too late. Markets don't break at obvious points. They break at misunderstood ones, and 100 risks becoming exactly that if it's treated as an outcome rather than a test. Silver's behavior above 94 has already hinted that tolerance is being measured quietly, through time and restraint rather than speed, a process that favors sudden resolution over gradual adjustment. When that resolution comes, it will likely feel abrupt not because it was unpredictable, but because the pressure was allowed to accumulate without release. In that sense, the difficulty of 100 isn't psychological, it's structural, rooted in how much imbalance has been carried forward rather than cleared along the way. And as silver continues to hover between validation and consequence, the market is left facing a familiar truth it rarely likes to acknowledge. The hardest levels aren't the ones that stop price, but the ones that expose what price has been standing on all along.